Greetings, everyone. Welcome to the second module of forward contracts. In the first module, we talked about basics of the forward contracts. What is a long position? What is a short position? It is an OTC product. We also discussed about how to use forwards for hedging and what are the different payoff profiles for buyer and seller of a forward contract. In this particular module, we are going to talk mainly about pricing a forward contract and what is a forward rate agreement. So let's start. So consider a stock that pays no dividend. So this is the first assumption which we are going to make. Later on in further slides, I'm going to show you what are the relevance of these assumptions. But as of now, let's assume that this is the first assumption which we are making. So consider a stock that pays no dividend, our assumption, and it is worth $60 today. In the market, you can borrow or you can lend money for 1 year at 5% interest rate. So this is your risk-free interest rate. Another assumption. Okay. So now, if this is the spot price and this is the interest rate, what should be the 1 year forward price of the stock? This is what we need to calculate. The answer is very simple, $63. And how do we calculate this? Just take 5% of 60. Right? So 60 is the spot price and 5% of it will give you a forward price of 63. Now, our objective is to first of all understand whether this logic is correct or not. Okay. So if the forward price is more than this, say let's say it is $67, then you have an arbitrage opportunity. Now, what is an arbitrage? Arbitrage is a situation where you can trade without risking anything and you're certain to make certain amount of profit. So if the forward price is 67, we calculated that logically it should be 63. So what you can do is you can borrow money, which is $60 you can borrow for at the rate of 5% interest. From these $60, you purchase the stock, which is for $60, and you immediately sell the forward, right? Because forward is trading at premium. So forward, you sell at $67 and then you just wait. So after paying off the loan, that is after 1 year, you will receive $67. You have to deliver this year, you will receive $67. You pay off $63 to the bank and you keep $4 as your profit, right? Now, why this has happened? Because the forward price reflected in the market is not making sense as per the calculation for the forward price. So now if the forward price is less than $63, right? So this should be the right price, but let's assume it is $58. So now you can play the opposite game. What you can do is you can sell the stock today for $60, right? And then buy the same stock in a forward contract for 1 year. So in a forward market, now you are a buyer. So you are selling the stock for $60 today, put this money in a bank, earn 5% interest. After 1 year, withdraw the money, right? And then buy back the same stock for $58. That means here you made a profit of $2 plus at 5% interest, you made what? You made around, not on $60, it's actually 58, right? So you made a profit of around 2.3. So similar to $4 profit, you reach somewhere around that number here as well. So forward contracts are easier to analyze in futures contract because first of all, there is no daily settlement in the forward contract, right? So there is no mark to market. This is not applicable to a forward contract because forward contract is an OTC contract. Okay, so single payment is going to happen at maturity, no exchange before maturity. Forward price and future price of an asset are though usually very close. They trade very close to each other. This is convenient because it means that whatever result we can obtain from the forward pricing, same can be applied or same can be construed as true for a futures contract as well. So if futures is trading too far away from the forward price, you have an arbitrage opportunity in the futures market as well. Now, to understand the pricing thoroughly, let's first of all understand what is the difference between an investment asset and a consumption asset. Okay, this is very crucial. Investment assets are those assets which anyone is purchasing mainly for investment purposes. For example, people buy stock, they buy bonds, correct? So they are not going to consume stock, they're not going to eat the stock or bonds, right? Neither they are going to wear it. They are just going to invest in these, right? Similarly, people also invest in gold and silver, though sometimes you can say gold and silver are consumption assets as well. But people look at these also as a point of view from the point of view of investment. A consumption asset on the other side is purely for consumption purposes, right? For example, your copper, your crude oil, your corn, etc. Right? I'm not saying that people do not do trading on these, but mainly these are consumption assets. Now, why we need to differentiate between these two assets? Because we can use the arbitrage argument, the one which I showed you here in the first slide, the arbitrage opportunity. We can use this argument to determine the forward and future price of an investment asset, right? But for a consumption assets, there are other things also in the play. There is inflation, there is interest rate, there is demand, there is supply, there is weather, lot many things come into the picture. So this logic may not be completely applicable, as in logic of forward pricing, may not be completely applicable on consumption assets. So now, since we have cleared the air that this logic mainly applies on investment assets, let's look at some of the assumptions which we make when we do the forward pricing. The first is that market participants are subject to no transaction cost. This is not true, but we have to make this assumption. Why? Because first of all, let's understand that these assumptions are true or not. I'm telling you right now, they're not exactly true. But for some traders, it might be true. And who are these traders? They are the big market players. And these are the players who actually move the market because of their buying and selling. So just assume that these assumptions are applicable for these people, big market players, okay? So are they subject to transaction cost? Rarely. Market participants are subject to same tax rate on all net trading profits. That's true if you're talking about them. The market participants can borrow money at same risk-free rate of interest as they can lend money. Not always true, but let's assume true for the big market players. Then market participants take advantage of arbitrage opportunity as they occur. Definitely true and definitely true for the big market players. So these are the assumptions. Now let's look at the forward pricing. Okay. So the easiest forward contract to value is, first of all, a contract which is written on an investment asset, not on the consumption asset. And second, that up till maturity, it should provide no income to the holder of the contract. Okay. So a stock which does not pay any dividend, or a bond which is a zero coupon bond. Zero coupon bond is a bond where you receive money only at maturity, right? So no interest, no coupon during the term of the bond, right? So both of these do not provide any income during the life of the contract, correct? So consider a long forward contract to purchase this kind of a stock, non-dividend paying stock in 3 months, okay? So you are long on a forward contracts for 3 months. Now assume that the current stock price is $40. Okay, so we have two numbers till now. We have spot price, which is $40. We have timeline, which is 3 months. And the risk-free interest rate is 5%. So risk-free rate of interest is 5%. We need only these three numbers to calculate the forward price. Okay. So now suppose first that the forward price is $43. So market is saying that the 3 month forward price of a 3 month price of a forward contract on this particular stock is trading at $43. So now an arbitrager can borrow $40 at this interest rate for this time period. Okay. So now if you do that, if you do this, this is what I was explaining, that you borrow $40 at 5% annual interest for 3 months. So you will end up paying $40.5 after 3 months. This 50.50 or 50 cents is the interest which you are paying. And at what price the forward is trading? 43. So that means there is an arbitrage opportunity. So by following this strategy, what you need to do is you are going to sell this. So whenever something is overpriced, I'll write it here. Whenever something is overpriced, we sell. Whenever something is underpriced, we buy. So here, forward contract is overpriced. Logically, it should be 40.5, but it is at 43. It is overpriced, so we sell it. Okay. So once we sell it, so after 3 months, we are going to receive $43. From this $43, if we take out the money which we have to pay to the bank because we borrowed for 3 months, right? We will end up making $2.5 as our 3-month profit. Okay. Now suppose next that the forward price is not $43, it is $39. Go back. Logically should be 40.5, but it is trading, forward price is trading at $39. That means, and in the forward market, this stock is underpriced. So what we do, we reverse the situation. So here we are going to buy, right? So we are going to short one share, right? And invest the proceed at 5% per annum for 3 months. So we sell the stock for $40. We got the money. We invested this money. And after 3 months, we received $40.5, right? So at the end of 3 months, we are going to pay $39 and take the delivery of the same share which we sold initially, right? What is the difference between the two? This is the money we received, as in we sold stock for $40. We invested it in the market at 5% interest rate. So after 3 months, we received 40.5. Then we paid $39 to buy the same stock. And this is the profit which we made. So if we want to generalize the whole thing, generalize the whole formula, forward price is nothing but spot price multiplied by your exponential ratio. You can say regarding your interest rate and time, right? So $40 is your stock price, right? 5% is the interest rate. 0.25 is 1 quarter, that is 3 months out of 1 year. So forward price should be 40.5. Now, if forward is more than spot, you can buy the asset and short the forward contract because it is overpriced. So whenever something is overpriced, we sell. So forward is overpriced, so we sell it. Shorting is nothing but selling. If forward is less than this calculation, right, then it means it is underpriced. Underpriced means we are going to buy the forward contract because it is underpriced. Okay. I hope till now everything is clear regarding your forward contracts. Now let's move on to forward rate agreements. So forward rate agreement is an OTC transaction, and it is specifically designed to fix the interest rate. Okay. Now when you're fixing the interest rate, you need to first of all fix the principal amount. You need to make sure whether you are a borrower or you are a lender. You're going to see the difference later, and you need to fix the time period. Okay. So fix the interest rate, fix whether you are borrowing or lending, fix the principal, and fix the time period. Now, the usual assumption in the market is that the underlying contract is that in this underlying contract is that whether you are borrowing or lending doesn't matter. It has to be done on LIBOR, that is London Interbank Offered Rate. So if the agreed fixed rate, which you have agreed here, right, this rate is greater than the actual LIBOR rate for the same period which you have fixed here. So in this situation, I'll write here fixed rate as per your contract minus LIBOR. If this is more than 0, then borrower has to pay this difference to the lender. Okay, because interest rate, oh, okay, let me put another scenario as well. If LIBOR is more than your fixed rate, then lender will pay the borrower the difference between the two. So LIBOR minus your fixed rate as per your contract. If this is more than zero, then lender will pay the borrower this difference. Now, because interest rate is paid in arrears, the payment of interest rate differential is due at the end of the period. Basically, it means your contract starts on January 1st and expires on March 31st, 3-month contract. So you are going to pick the LIBOR rate of January 1st, and then you are going to do this calculation, but the actual payment is going to happen on March 31st. This is the logic of your forward rate agreements payment. But usually what happens in the market is they discount back this price and make the payment today itself. That means at the beginning of the specified period. Now let's take an example. Suppose that there is a company which enters into this FRA contract, and this is designed in such a way that this company will receive a fixed rate of 4%, right? So they are receiving fixed. So that means they are lender, right? Principal is also fixed, which is 100 million. And then the period is fixed, which is 3 months, which will be starting in 3 years. That means this contract will actually get activated after 3 years for the next coming 3 months. Okay. So FRA is an exchange where LIBOR is paid and 4% is received. Correct? Now let's go back, understand this logic again. This is for the lender, correct? If LIBOR is more than your fixed rate, that is your contract rate, lender will pay the borrower. Now let's look at this example. Okay. So here, let's assume that 3 years after, the LIBOR rate was 4.5 percentage. Okay. So now how much is the fixed rate? The contract rate is 4%. So since LIBOR is more than your contract rate, lender will be paying the borrower. Okay, same logic here, which I explained. LIBOR is more than fixed rate, lender will be paying. So 100 million is your principal, and how much you will be paying? 4%, which is the contract price, minus your LIBOR, right? That means you will be paying 0.005 percentage, right? 0.005 multiplied by timeline. What is the timeline? 3 months. So this is your 1 quarter. So you will be paying, as in lender will be paying, in 3.3 years, $125,000, right? But as I explained to you, you can discount it back and then lender can pay at the end of 3 year itself, not at the end of 3.25 year point. At the end of 3 year itself, lender will pay $123,609 because we discounted it back and brought it to the initial period. So in summary, to calculate the forward rate, multiply your spot rate by your ratio of interest rate and adjust for the time for expiration. Forward rate agreement is an OTC product, okay, and it is designed specifically to fix the interest rate. In forward rate agreement, usually the present value is paid at the beginning of a specified period. It is discounted back and brought to the beginning of the period. So this is the end of this training, Introduction to Forward Contracts. I hope you liked it. And as I mentioned yesterday, that if you want more trainings, we have a whole gamut of trainings which we are providing on Treasury and other modules as well. Please have a look and enjoy our trainings. Thank you so much for sharing your time with me.